Hi everyone, and welcome to the solution video for problem number 1 here in Learning Objective 5-3, where we have been talking about finance/sales type leases. Now, if you remember, what we said prior was that if we are talking about the lease from the perspective of the lessee, we are going to call a lease in which control is transferred from the lessor to the lessee. We're going to call it a finance lease. And if we're talking about a lessor, the lender of the asset, the lessor, we're going to call this a sales type lease. And really, we're talking about the same thing, but we give it two different names here. So if it's the lessor, the owner of the asset, we're going to call it a sales type lease. And if it's the lessee, the user of the asset, the borrower of the asset, we're going to call it a finance type lease. And the important thing to recognize here is when we have this type of lease, it's as if we have a sale of an asset that is structured in the form of a lease. Okay? So it's really in substance, it's a sale of an asset, but it's being structured in the form of a lease. And if this is true, the accounting that we need to perform needs to consider the substance rather than the form of the lease. So we want to account for this as if it were a sale, even though the legal documentation, the agreement here is written as if this were a lease. All right, so we're going to record the accounting for this arrangement as if the seller is selling the asset to the buyer, or if the lessor is selling the asset to the lessee. All right, that's the idea here. Okay, so let's give ourselves some room here so that we can work this problem. And what I'm going to do is I'm going to record the journal entries for this lease arrangement. I'm going to record it both for the lessor and the lessee. Okay. All right. So the problem reads: a finance sales type lease agreement calls for quarterly lease payments of $5,376 over a 10-year lease term, with the first payment on July 1st, the beginning of the lease. The annual interest rate is 8%. Both the present value of the lease payments and the cost of the asset to the lessor are $150,000. So the nice thing about this problem is they tell us right out of the gate that this is a finance sales type lease. So we do not need to consider the 5 criteria to classify this lease as being either finance or sales type or an operating lease. And if you remember, the criteria were we have to consider, does the lease talk about ownership being transferred? The second criteria here was, is there a purchase option that is reasonably likely to be exercised by the lessee? So is there a purchase option? Number 3, what is the useful life of the asset compared to the lease term? And if you remember, the rule that we used was if the lease term was 75% or more of the useful life of the asset, we in effect had a sale of an asset rather than a lease of an asset. The fourth criteria was were the present value of the lease payments greater than 90% of the asset's fair value. All right, and so if you're paying more than 90% of the asset's fair value, effectively you have a sale. And then the last criteria was, do you have a custom asset? Okay, and normally we would take a lease and we would look at each of these criteria, and if the answer to any one of these questions was yes, we would say we have a finance/sales type lease. Well, we don't have to do that here because they're telling us up front this is a finance sales type lease. All right, so let's get back into the accounting here, and let's look at the journal entries. Okay, so let's look at the lessor and the lessee, and actually, I think it would make more sense if I put the lessee on this side. Let's consider the borrower first. All right, so we're gonna have the lessee and then the lessor, and then prepare the journal entries. It's saying prepare the journal entries necessary on July 1st and October 1st. Remember, this is a quarterly lease payment lease, so that's why we have July 1st and October 1st, 3 months difference there. And so we're going to record the journal entries on these two dates for the lessee, and then we're going to do the same thing for the lessor. Okay, so number 1 is the lessee, number 2 is the lessor. That's why I rewrote it here, so it makes more sense. And let's organize ourselves here. And so let's look at the July 1st entries. Okay, July 1st, the lessee. So what happens on July 1st? On July 1st, the lessee gets the asset. So what we're going to do is we're going to create a new asset, and when we're talking about a leased asset, we're going to call it a right of use asset. Okay, and we're going to simultaneously record a lease payable, okay, for the amount we owe on the lease. Now, the important thing here is that the value of this lease asset is always equal to the present value of the lease payments. So we're going to just make a note for ourselves here. And so the right of use asset equals the present value of the lease payments. And if you look at the problem here, it's saying the present value of the lease payments and the cost of the asset are both equal to 150. Okay, so that's why we're recording the 150 here. Now, that won't always be the case where the cost of the asset is equal to the lease payments, but in this case it is. So just keep in mind that we always want to record the value of the asset at the present value of the lease payments. All right, on the lessor side, what do we record? So on the lessor side, we're going to record a lease receivable, and we're going to credit the asset. Because remember, this is in effect, a sale of an asset from the lessor to the lessee that's being structured as a lease. So in substance, it's a sale, and so we're going to record it as a sale rather than a lease. So substance over form here. Okay. What else happens on July 1st? Well, the second thing that happens on July 1st is lease payments are typically structured as annuities due, where the first payment is made on the first day of the lease. So we have to also, on July 1st, we have to record the first lease payment. And so we are going to record a debit to the lease payable, right? Because we're making our first lease payment, that reduces the payable. And we're going to credit cash. And the payment is given in the problem. The payment is $5,376. So that's the amount we're going to record here, $5,376. Okay. And then on the lessor side, the lessor is going to receive the cash and reduce the receivable for the same amount, $5,376. Okay. Easy enough. All right. So the next step here is to record the entries for October 1st. So let's give ourselves some more room to write, and let's erase these entries, and let's go to October 1st. All right, October 1st, what do we do? October 1st is the next lease payment, okay? And just like we did on July 1st for the lessee, let's write lessee over here. Lessor. I'll just put this up a little higher so we have more room to write. We are going to reduce the lease payable, just like we did on July 1st. And we're going to credit cash, and the cash payment's going to be, again, $5,376. But this time, we have, it's not, this payment of $5,376 is not just reducing the payable, because we said this is in effect the sale of an asset and it's being financed over a period of 10 years. And the interest rate for that type of arrangement is typically 8%. So what we also have to record here is interest expense. Okay, so we're going to say debit interest expense. So we're going to split that payment of $5,376. Part of that is going to go to interest. Part of it's going to be to reduce the payable. So how do we calculate the pieces here? So what we do is we say, we're going to use the effective interest method. And we're going to say, what is the balance of the lease payable? Right, so we're going to say the balance of the lease payable is $150. That's what we started at. And then on July 1st, we made a payment of $5,376 that reduced the payable. And then we're going to multiply that by our interest rate, which is 8%. But it's an annual rate, and we're talking here about a quarterly payment. So we have to split this into 4 quarters. Okay? So we're going to do 150,000 minus 5376, whatever that balance is, multiplied by 2%, which is the quarterly equivalent of 8%. Okay? And if you do the math, the number that you will get is $2,892 for the interest expense. The rest of this $5,376 payment reduces the amount that we owe on the payable. So this will be $2,484. Okay. All right. How about the lessor? The lessor, again, like before, is going to debit cash. They're receiving $5,376. They're going to reduce their lease receivable. And just like we had interest on the lessee side, we also have interest on the lessor side, but for them it's revenue, interest revenue. And it's going to be the same amounts. So it's going to be the $2,892 that we calculated over here, right? $2,892, which was based on this calculation down here, right? The interest revenue is going to be $2,892, and the lease receivable reduction is going to be the same as the lease payable reduction, which is $2,484. Okay. All right. And last thing, on October 1st, if you remember, on July 1st, we recorded a right of use asset. If you add an asset, you add a capital asset, you also have to record depreciation expense. So we have to worry about that now for the lessee. The lessee recorded that asset. And how do we calculate it? Well, what we say is we're going to do straight line depreciation. The asset's value is $150,000 to start. It's expected to have a 10-year useful life because it's a 10-year lease. So we're going to say divide this by 10 years. And we're recording this for a quarter. So we're going to also divide that. We're going to divide that by 4 quarters to get our quarterly interest expense. Okay. So we're going to say depreciation expense, right? But on a leased asset, it's going to be called amortization expense instead of depreciation. Amortization expense. And instead of using an accumulated amortization account, we're going to just credit the right of use asset. And the number that you will get if you do this calculation down here is going to be $3,750. Okay. All right, so that is all of the accounting for the lessee. The lessor, fortunately, in the first entry on July 1st, they credited the asset. They no longer have the asset, so there is no depreciation on that asset because they no longer own it. So there's no entry for the lessor related to depreciation here. All right, well, that is the end of this solution video. I hope this solution video has been helpful to you in understanding the accounting for finance and sales type leases. Thank you very much for watching. Take care, and I'll see you real soon.